Welcome to the Economic Depression and Preparation Channel 2024. Thank you for joining me on today. We're going to briefly recap what happened today, but the stock futures fall, according to CNBC.com, as the Fed awaits the Fed, and stock brokers await the Fed's preferred inflation guides, the PCE, the amount of spending that Americans have had. So the Dow Jones was down today. Futures are down 80 points. As of after 5 or 6 p.m. Eastern time. So the Dow Jones was down 0.2% and 0.25%. The S&P 500 futures were down respectively. And so this is what's going on, folks. We have a chance here that everything is going to be going down. The major indices will decline in doing regular trading. And this is all based on the fact that investors have been wanting rate cuts as early as May or April of this year, and now it looks likely that the interest rate cuts are not going to be happening until the second half of this year, possibly after the elections, basically. But right now we have a situation where the stock market is starting to lose steam, and the Dow Jones heads for a fourth straight winning month, which is good news, even though the Dow Jones has been down for the last 2 to 3, 4 days here. So the Dow Jones streak, if it closes tomorrow in positive territory for February, it'll mark the 30 time. It will clinch the 30-year, the fourth straight winning month for the first time since it ended in May 2021. So the index is still up 2.1% month to date. But you have to remember this, ladies and gentlemen, we still have a debt of $34 trillion, and this debt is not going anywhere. Remember, we printed up a bunch of money these last 3 or 4 years with all this pandemic spending. And so when you print up money, that takes a long time for it to get through the system. Now, we still have elevated prices in food, water, utilities, gasoline, elevated rents and more rent prices and high home prices that are continuing to rise, albeit at a slower pace. That's the good news. The bad news is all of these debts, all of these liabilities are still rising every single minute, every single hour of the day. And that's going to be a big problem. Now that it was still in tax season, as you know, and so that's some people may be getting refunds, so that may be helping out in this next month, March and April. But after that, all bets are off, as this continues to be a $34 trillion debt economy, and inflation has not stopped. It's still there. It's just not moving at a faster pace. And that means that as inflation rises, taxes are going to rise, property taxes, home insurance, auto insurance is going to continue to rise every 6 months or 12 months. And this is not a good look for this economy. The good news is we all have time to continue to prepare. What may feel like we're in Babylon, we still have time to prepare physically, mentally, spiritually, and emotionally. Even though things are declining day by day, crime is going up in every city, not just in the ones that we typically hear about, like Baltimore, Detroit, Philadelphia, New York. Crime is going up across the board, and even safe neighborhoods. I'm sure you've seen that too as well. Now, U.S. economy today is this week's economic data making investors skittish. As you know, people are looking at this data and they're saying to themselves, this doesn't add up. A lot of economists saying that inflation measures don't count as a huge cost that's driving economic unhappiness. They're saying a lot of people are unhappy with the way the economy is going, with some of the decisions that are made in Washington, D.C. And now they're saying that, according to economists at Harvard University and the IMF, they examined how today's high interest rates on mortgages, credit cards, and other loans, how are they measured in the consumer price index. So interest rates are at the highest level in decades because the Federal Reserve was trying to fight inflation. But when you fight inflation, you must also raise wages. Real wages, nominal wages, have not increased for the last 40 years for Americans. And this has been the problem. Wages are not keeping up the pace of this inflation that we're saying are keeping up with the debt levels that most Americans have, whether that's consumer debt, credit card debt, student loan debt, whether that's other medical debt. All of these debts, as you see here, or whether it's Social Security, any kind of debt, whether corporate, professional, government, it's all the same. And wages have not been keeping up with that. And so this is the problem that we're running into with this American economy. But this is a worldwide thing. As I've been telling you before, this worldwide next depression or recession or whatever you want to call it is going to be worldwide. It's not just limited to the United States. Every country's reporting that they're having the same problems, and they're doing, all of their central banks are doing the exact same thing, raising rates and hoping for the best and printing out a bunch of money. And that can only last for so long. So they keep saying they want to get to this path of 2%. When do they get back to the 2% target is anyone's guess. My guess is we probably never will get back to 2%, just like we'll never see 3%, 2% mortgage rates again in our lifetime because of the way this economy is. Okay, so this is what's going on. And we also have the January PCE with inflation report. That's going to get a lot of attention tomorrow. That comes out around 8:30, I believe, in the morning, or 9 o'clock Eastern time. So be on the lookout for that. The Commerce Department said on Thursday they will release the January reading of the Personal Consumption Expenditures Price Index. This is just a fancy way of saying how much Americans are spending every month on, basic necessities and on luxury or leisure activities. And so economists are forecasting a 0.3% monthly gain and a 2.4% 12-month move, according to a Dow Jones survey. So they think that the senior economists are expecting, they think the Fed holds tough on tight economic policy. It could pose a substantial risk, danger to the expansion. In other words, if the Federal Reserve says we're going to leave rates unchanged next meeting, or if they say we're going to raise rates, they say it's going to further slow down this economy and raise more debt into this economy, into this system, and that's something that they don't want. So that's something that we're going to have to watch closely as we head to the back part of this week. Let me know what you think in the comments. Do you think that we are going to be seeing more job losses coming up in March and April? Do you think that we're going to see inflation numbers come down? Is it going to remain the same, or is it going to go up as we head into March? There's an old saying, beware the ides of March. And, this is what I feel like with the stock market as well. There's always going to be this black swan event. I think there's going to be a black swan event that's going to happen before the summer, before June, that's going to cause the Fed to have to take drastic actions, austerity measures, as they call it, to help get this economy back on the right track, unfortunately. So let me know what you think. Stocks futures open lower Wednesday evening today. It slipped 70 points. We're already down 70 points on the Dow Jones, S&P 500 futures, and NASDAQ futures are edged down 0.2% each. Let me know how you think this is going to turn out once these numbers come in, and we'll talk to you very soon. Thank you very much.